For most people, CPF is something you only start thinking about after you start working. But for some kids, their CPF journey starts before they can even crawl. That's because a growing number of parents are now topping up their children's CPF accounts, sometimes even from the moment they are born. As of 31st December 2023, there are already 3,400 children under the age of 5 who have money sitting inside their CPF special accounts. Congrats, happy for you, nice. Now, before you be like, "Aiya, the parents must be rich people lah." Not really, yo. Among all the givers who top up their children's CPF through the retirement sum topping up scheme, around 8 in 10 actually live in HDB flats. So this isn't some crazy rich Asian thing, but rather regular Singaporean parents are doing it too. But then that raises an interesting question. Is it really a good idea to top up your kids' CPF? After all, this isn't money that they can use for education, housing, or even a rainy day. Instead, it is locked away for decades. I mean, I don't even know what I'm having for lunch later, much less what CPF will look like 50 to 60 years from now. So in this video, we will take a closer look at the pros and cons of this strategy and whether this strategy is truly worth it. Alright, let's jump right in. Now, this strategy was popularized by Mr. Lu, the founder of the 1M65 movement, and his idea was simple. If you just top out $65,000 to your kid's CPF SA right at birth, with the magic of CPF compounding, that kid will end up with $1 million in CPF by the time they turn 65, essentially turning them into a CPF millionaire before they even know how to walk. Now, of course, $65,000 is a lot of money, and ain't nobody got savings for that. But the good news is that you don't have to dump it all into CPF in one shot. You could start small, say a few $1,000s at start, then make annual top-ups for a few years, then thanks to compounding, your child could still end up hitting that $1 million mark at 65. Voila! But then, realistically speaking, how much is $1 million worth by then? The long-term average inflation rate in Singapore is about 1.7%, but let's round it up to 2% for simplicity's sake. At 2% inflation, over 65 years, that's $1 million shrinks to about $269,000 in today's dollars. That is actually just slightly above the current full retirement sum, which will get you around $1,600 to $1,700 in today's terms, which is like meh. But here's the thing, that's not the full picture. Because when your child starts working, they will also contribute to their own CPF. So assuming they start with a $4,000 salary, get a 2% pay increment every year, and use $1,000 money for their home loan. By the time they reach 65, their total CPF balance could reach around $2.7 million, enough to hit the enhanced retirement sum, or probably even more. So even if inflation eats away at the $1 million figure, the combination of your early top-ups plus your child's own CPF savings would still set them out for a very strong retirement foundation. Quick pause. If you are looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry, at just 35 cents per trade on the US stock market. It also offers Ireland domicile ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. Besides that, there are actually a few good reasons why some parents choose to top up their kids' CPF. The most obvious one is that the returns are guaranteed. Both the special accounts and the MediSave accounts earn 4% interest, plus an extra 1% on the first $60,000 combined. So effectively, the first portion of your kids' CPF is earning 5% risk-free interest every year, backed by the full faith and credit of the Singapore government. That's incredibly solid, especially when you compare it to bank fixed deposits or Singapore government securities. Over the past decade, 30-year SGS bond yields have ranged between 1% to 3.5%, which means CPF easily outperforms them. So in a way, you can treat your kids' CPF as their bond allocation, where it will form a safe, stable and reliable part of their future portfolio that compounds steadily in the background. And that can be powerful, because with this financial safety net in place, your kid might feel more confident to take calculated risks later in life, like maybe start a business, invest more aggressively, or even switch careers, knowing that their retirement foundation is already secured. Then there's also the added benefit of zero drama and zero management risk. Once the money goes into CPF, it stays there and quietly compounds year after year. Your child can't withdraw it early, can't spend it on nonsense stuff like labubu, and can't lose it in some random scams. So in a sense, it's like creating a trust fund for them, where it's managed by the Singapore government, earns 4 to 5% interest a year, and charges zero fees. Sounds good, right? Well, not quite, because the biggest drawback is of course liquidity, or rather the lack of it. Once you top up your kid's CPF SA, that money is effectively locked away until they turn 55, and even then, it can only be used for retirement. You can't use it for education, housing, or emergencies. The second issue is opportunity cost. Over a 30 to 40 year period, equities such as a global index fund have historically returned 6 to 8% a year, which is far higher than CPF's 4%. That difference might not sound like a lot, but over decades, it adds up to a completely different outcome. Roughly $9.6 million from equities versus just $1 million in CPF. So by locking your money in CPF, you are trading potential growth for safety. That might be fine for conservative parents, but for someone who is comfortable with market risk, CPF returns can be quite underwhelming. And of course, there's always policy risk. The CPF Special Accounts floor rate is reviewed every quarter, and while it's been capped at 4% for many years now, there's no guarantee that it will stay that way forever. In fact, back in the 1990s, CPF SA interest rates once dipped to between 2 and 3% before the government introduced the current 4% floor rate to provide greater stability. And the reason CPF can offer such high interest is because it is pegged to long-term government bond use, with a minimum floor rate set by policy. So as long as Singapore's fiscal position remains strong and long-term government bonds continue to yield around those levels, CPF members can continue to enjoy these higher risk-free returns. But if global interest rates fall and stay low for many years, or if fiscal priorities shift, like if the government needs to allocate more funds to social spending, infrastructure, or healthcare, then there might be pressure to realign CPF rates closer to market levels. Even if that doesn't happen now, we are talking about a 50-year horizon. Over half a century, anything can happen. Policies can change, government can change, and the world's financial landscape can look completely different. That's why while CPF feels rock solid today, it is still not immune to future changes. Which brings us to the other side of the debate. Like, what if instead of locking up your child's money in CPF for 50 years, you simply invest it in the markets instead? One of the biggest risks with investing is that people tend to rely too much on historical data. We love quoting numbers like the S&P 500 has averaged 10% a year, or global equities return around 8% long term, but those are just past numbers and not actual guarantees. For example, if you were born in the 1950s and started investing in your teens and 20s, right through the 1960s and 1970s, the stock market would have gone almost nowhere for 2 whole decades. The US was struggling with high inflation, oil shocks, and stagnant growth. And even after adjusting for dividends, your real returns would have been close to zero for many years. And this isn't just some ancient history. Japan's stock market, for example, had recently just recovered to its 1989 peak, more than 30 years later. So, while global equity investing like VWRA has historically outperformed CPF by a wide margin, it also comes with long periods of underperformance, and that is something most investors forget. On the other hand, with CPF, while you will never get a double-digit growth, you will also never wake up to a 40% crash. It is slow, boring, and predictable, which, depending on your goals, might be actually what you want. So, with that being said, who does this really make sense for? The short answer is, it's not for everyone. If you are someone who's still trying to get your own finances in order, like trying to build an emergency fund, paying off high-interest debts, or haven't maxed out your own CPF top-ups yet, then your priority should still be yourself first. Because the best gift you can give your child isn't some big fat CPF balance, but rather is a parent who's financially secure and independent. The last thing you want is to build their future at the expense of your own, only to end up relying on them later. On the other hand, if you have already made it in life, your mortgage is paid down, your retirement fund is on track, and you have got some spare cash lying around, then topping up your kids' CPF could be a meaningful legacy move. This isn't about spoiling them, it's about creating a guaranteed safety net for their future. Think of it like an endowment plan, or a super long-term fixed deposit that quietly compounds in the background. But if you are an investor who has a higher risk tolerance and is confident that you can outperform CPF's 4%, then locking up money for 50 years might not suit you. In that case, keeping the funds flexible and investing on your own terms could potentially deliver better long-term results, though it may come with a lot more volatility and uncertainty along the way. Now, if you still like the idea of giving your child a head start through CPF, but don't like the idea of locking up money for half a century, there's actually another way to achieve a similar goal, but with more flexibility. And that is by topping up your child's Medisave account instead. This option gives you a nice middle ground, where the money is still safe, still earns a steady 4 to 5% interest, but unlike the special accounts, it doesn't have to sit untouched all the way until your kids become an old apet or old ama. Instead, the funds in MA can be used much earlier, whether it's for medical expenses, hospital bills, or insurance premiums like MediShield Life and Integrated Shield plans, which are getting more and more expensive every year. So instead of being locked up purely for retirement, it becomes a health safety net, one that could really come in handy much earlier on in life. And here's the part most people don't realize. Once your child's Medisave account reaches the basic healthcare sum, which is $71,500 as of 2025, any excess Medisave contributions will automatically overflow into their special account. So even if you start with the MA, you are eventually still helping your child grow their CPF SA balance, just through a more flexible and more useful starting point. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting every week.